Okay, we are very fortunate. Welcome everybody that's coming on to the webinar. We have got 1 hour together, and Mr. Neuwirth has given us a little bit of extra time if we go past the top of the hour for questions. So jot your questions down. I realize you may only have allotted an hour for this conversation and this presentation by Mr. Neuwirth, but if you have some questions, this is your chance, because this is a live webinar, not something that's just recorded and somebody reading things off. And he is open to answer your questions to go overtime. And so we appreciate very much his time, which is incredibly valuable. We are, of course, highlighting Peter Neuwirth's book. And for those of you that are financial advisors, this is information that it can be given to your clients, but it's also information for you. I think one of the most important explanations of the book, I've read the book. You can see that I've got it, a whole bunch of little dog ears here of different points that I've highlighted and underlined. But Peter Cahill, Chief Executive Officer at Capacuity, said, Pete's observations on how to ensure financial wellness over a lifetime are based on his deep knowledge of money and probability, complexity and change, and the quirks of human nature. Now, that's a lot of variables in there. Probability, complexity, change, quirks of human nature. That's infinite amounts of complexity right there. The book is funny, frank, and realistic about how to navigate financially in an uncertain world. I don't know if we've ever had a more uncertain world than now. Maybe we could say it was uncertain back in World War II and we didn't know who was going to win, or, during the wars between the Cowboys and Indians and what was going on in the West. There's a lot of things that we could say, but I don't know. In my lifetime, this is about as scary and as maybe since 9/11 that I felt as uncertain about what we could really be sure about in the future. This book should be required reading. It should be required readings. My son went through law school, 7 years of 4 years of undergrad and 3 years of law school. He doesn't know a lot of this stuff, and he should. This should be required reading for anybody in college, say nothing about high school, and certainly for those of us that are in the financial planning world, because we are responsible for not just having the same information that Money Magazine has, or what's out there that anybody can pick up in the Wall Street Journal. We need insights. We need understanding that goes to level 2 and level 3. And that's what Peter Neuwirth does. And most people that are really into actuarial stuff and math tend to be kind of boring. His book is anything about that. There's all kinds of fun, cool stuff in there and stories. I mean, a chapter, Fat Tails, Black Swans, Buying Barbells, and then the real factual stuff of what kind of advisor should you be, even going into what's the future of money? Is it digital currencies? And through it all, he gives you 6 principles that he's going to talk about and 4 tools that we need to have in our backpack when we're heading out into the scary financial mountains. I don't want to take any more time. I just want to set the stage to make sure that you understand how important this next hour is. I can't think of any better way for you to spend your time in the next hour, hour and a half as questions are answered, because this is critically important information that you need to know. And if you don't, you are not going to where you want to go. And if anybody's ever been lost in the woods, it's not a good place to be lost. Peter, thank you for being here. We're thrilled that you're taking the time to educate not only our loan officers that are advisors, but all of our partner advisors that are looking to you for some great information.
Well, thank you very much, Harlan, and I'm really thrilled to be here. And you guys have been very, very hospitable to me, and I really appreciate it. And I'm here, I guess, because I got very interested in reverse mortgages by a guy I used to work with, Barry Sachs. He was the attorney on one of the clients that I was an actuary for, and so he sort of turned me on to the product, and I got very, very interested in it because it's a very interesting actuarial and other financial product. And I think it's a very good one. But I understand that I've got here today a kind of a bifurcated audience, which is kind of interesting and unique for me, because I've got a bunch of, it sounds like I have a whole lot of very knowledgeable experts in the area of reverse mortgages. And I also have a bunch of people who are, I guess, for lack of a better word, financial planners or referral partners or whatever, as I understand it. So I'm trying to make this presentation interesting to both groups, which are, of course, there's a lot of intersecting interests. For those who are in the financial planning world, the referral partners, what you're going to hear is my manifesto. It's kind of my view of financial wellness and how best to, forage on and attain it. And for the experts in reverse mortgages, much of this is going to give you context and how what I think your product and the things you do for your clients fits in and is of great service to your clients. And just to get us started, I'll share a story that is not in the book, because it's the way I got introduced to the whole world of financial wellness and financial planning. And this was back in the fall of 1981. And I had just started my career. I was a young actuary. I started an insurance company and got recruited into the consulting world. I was working for Hewitt Associates at the time. And that's, their employee benefits consulting and actuarial consulting. And I was doing pension valuations and defined benefit actuarial work. And like I said, I was just a couple of years out of college and just starting to learn this stuff. And I was told to come to a training session for the actuarial students to learn about this new section of the IRS code. And it was Section K of the Internal Revenue Code, Section 401, which is the section that governs all of pensions and qualification. And this new Section K was going to be pretty exciting, according to the older actuary who was telling us about it. And, for the first time, people were going to be able to defer money from their own paychecks tax-free, and they're going to be able to accumulate it tax-free. And he said, this is going to be the future of retirement plans. And here I am just getting my feet wet, trying to learn defined benefit pensions and all the complexities associated with that. And now I got to learn something new. And this actuary says it's really important. So I paid attention. And of course, it's probably the only section of the code that most people know. And that's where 401k plans came about. And, so for the next 40 years or so, I, worked not just with actuarial valuations of defined benefit plans, but 401k plans. And, it's 401k, I think it's what you've seen is kind of the unintended consequences. Be careful what you wish for, because, for about 20 years or so, 401k plans, 401k was a wonderful, wonderful thing. And it still is. It allowed people to accumulate savings and resources that they can use in retirement far beyond what they would normally have had with their own savings program. But as time went on, it became a little bit less clear exactly what people were going to do with these 401k balances once they retired. So, like I said, at the outset, accumulating assets was pretty straightforward, pretty easy. It was a very successful set of programs that many companies had. But of course, a lot of companies thought, well, this is such a good thing, we can get rid of our defined benefit pension. And that we saw a huge movement from defined benefit pensions to defined contribution and profit sharing and 401k plans. And these days, most people, when they retire, don't have a defined benefit pension plan. They've got a 401k plan and they got to figure out what to do with it. And what they are facing is a big problem that nobody anticipated, which is the decumulation problem. It's easy to accumulate assets, not so easy to decumulate them. And so that's kind of where my focus has been for the last, I don't know, at least 5 to 10 years. It's not an easy problem. It doesn't have a straightforward solution, but I've got some things to say about it. And that's what we're going to hear about today. So now, you know, like I said, I was in the consulting world for, you know, a good 40 years. And, you know, towards the end of my career, I wrote a book. I wrote a book called What's Your Future Worth? And it was published in 2015. And I thought, you know, as an actuary, like I said, I've sort of lived in the world of money and kind of knew my way around it. And I thought, you know, but not just money, just in general, making decisions and navigating through life. And I always found the actuarial perspective very, very useful. And so I wrote a book, and that's what What's Your Future Worth was. It was a way to use the actuarial perspective to make better decisions, better life decisions. And it was published in 2015. And by then I was working for Towers Watson, and the firm was very, very supportive. They bought a bunch of copies, and I started talking about it to various groups. And what I found, to my surprise, although I guess I shouldn't have been, is that people were very, you know, they were kind of interested in what I had to say, but all the questions were about money. Everybody wanted to know what they should do about money and their financial situation. And I just was kind of, you know, surprised and you know, had a lot of empathy, because I you know, it came kind of easy for me. And, you know, a lot of the people my friends and people I work with, but for most people, money is a very, very difficult issue. And so, you know, we do whatever we can to get advice. And, you know, many of us are not so successful at it. And so that's when I decided that, you know, I know this stuff, and I kind of know how to apply the actuarial perspective to money, because, you know, that's fundamentally where the actuarial science came from. It was about how to deal with money. It was invented by a couple of French mathematicians who were gamblers, and they wanted to win money at the casino. And so they, you know, they invented probability theory, and then some more French mathematicians came around and started developing some statistical methods, and then, you know, to combine probability and statistics with finance, which people had known for a while. And that's when you've got a branch of mathematics that is directly applicable to the world of money. And so in 2016, I retired, and I decided to see if I could help. So that's where this book came from. And you know, it's why I wrote it. And you know, it's called Money Mountaineering.
And by the way, if I can interrupt just for a second, if anybody wants a copy of this book, of course you can order it on Amazon or wherever you buy books, but also you can get it from one of our loan officers at no cost. because we believe in education and working together as a partner with our financial advisors. And feel free, because we think it's that important to get it into your hands, because we're of like mind with Peter, and we want to make sure we get that information out there. So all you have to do during this webinar, type into the chat box or into the Q&A that you would like a copy of this book, and simply give us your name and your address and your phone number, and we'll make sure that we get that out to you. So thank you. I just wanted to interrupt that in case
No,
anybody.
that's great. I mean, really, Harlan, interrupt whenever you see me going off track, or even if you don't. So because I want to be as focused and tailored to your audience as I possibly can. So, but I think
Peter, excuse me just for a second, there's very few people that have that history. When you start talking about Section K and then 401, it was like, wow, that was the beginning, 1981. How many people do I know? How many people do any of you know that was in the beginning of the 401k that has seen the whole evolution of how it started and what's going on now and the effects of it? And now you're sharing and being in that same retirement. That's fascinating.
Well, I mean, I guess I was one of the younger ones, but it was a big deal, and a lot of people paid attention. A lot of people in the actuarial world paid attention, and we've been paying attention ever since. Yeah, it was a good thing. 401k was a very good thing. That was what was done, and but now we just need to deal with the consequences of having it been one of the bulwarks, one of the pillars of our retirement system for decades. So back to the book, though. I think it's important to understand what this book is not, as much as what it is. And I've talked about it now a few times with groups and people who have read it, and they come to it say, "Oh, so is this an investment advising book?" And because I didn't quite get it, and it's not an investment advising book. I mean, I don't make recommendations as to what you should invest in. Maybe if I get to know you really well, and I will tell you what I would do if I was in your situation. But I'll certainly tell you what I did and why I did it. And maybe if your situation is similar, you can learn from it. But I believe that the way you should look at this book is as a guide, a book that you should buy before you buy any tailored specific advice book. And the reason I say that is because there's an immense amount of challenge, and Harlan, you referred to that, which is that the world, first of all, is complex. The world of money is complex. I mean, very few people, in fact, I would say maybe nobody understands all of the world of money and how all the different vehicles, products, services are interrelated, how the people who provide those services, who help you with transactions associated in the world of money, how they're compensated, how they view those things. And it's too complex for any individual to really understand. Now, the good news is you don't have to understand the world of money. You just have to understand your situation, your relationship to it. But one of the things about your relationship to that world of money is just how it changes over time, and how you just never know what's going to happen to markets. You never know what's going to happen to the money. I mean, Bitcoin didn't exist when I got into the world, and now, digital currency, the Fed was not quite as hadn't had to be as active as they have been in the last few years. So you just don't know what's going to happen next. It's also noisy. There's lots and lots of people running around who are going to tell you what to do with your money and how to get rich, or how to not go bankrupt. And some of them are know what they're talking about. Some of them don't. Not anybody knows you specifically. So, and then on top of all that, we're irrational creatures. We're prone to biases. We're prone to systematic cognitive errors. We didn't evolve to choose between fixed and variable rate mortgages. We were evolved to know when a saber-toothed tiger was about coming down and ready to eat us. So these are the challenges we face. So, but here's the really important thing about that, is that these are challenges that nobody can face with you. I mean, they're your challenges, but that's okay, because nobody will know your financial situation and your, what's important to you, what you have, your assets, your liabilities, what your hopes, fears, and dreams are. Nobody except you. So you are the expert in your own financial world. And so I'm not trying to compete with anybody who's trying to give you specific advice. All I'm telling you is to try to empower you to make your way through this world. So where does the title come from? I mean, I think of the world of money as you're as a wilderness, and a big mountain wilderness, and you can get lost. You don't know what the weather's going to be. You just don't know what predators are out there, and this is not where you were evolved to live, but you got to, because you have to survive. So what I'm trying to do with this book is to give you a trail map, help you understand what the terrain is like, maybe a compass to show which direction you're going, and a pair of binoculars so you can sort of see what might be out ahead. So, as I say, I want to tell you, I mean, I've lived in this terrain for 40 years. I really love the world of money. People think I'm a little weird that way, but I just find it endlessly fascinating, and the fact that it's always changing keeps me interested in it. And so I'm comfortable there, but I can't impose that that level of comfort or excitement about hiking on the trails as others, because I know many people just want to find a safe place to pitch their tent and get by and enjoy the rest of their lives. So let me tell you how I look at this. One of the things I've loved about actuarial science and being an actuary is that it's an old science, and it's a science that has faced lots of problems. Like, how do you insure against things that almost never happen? How do you set up a company where you can insure the lives of great numbers of people? And many of those problems are not directly solvable. In math, for those who've studied math, there aren't closed form solutions. But that doesn't mean that the problems aren't out there and can't be addressed. And what actuaries have done for 200 years, when faced with new problems that don't have straightforward and closed form solutions, is they try to understand those problems and make some insights and develop a way of addressing those problems, usually through principles and fundamental aspects that you can rely on and can guide you. And so that's what I've done with this book, I hope, is to provide a set of 6 fundamental principles that will help you navigate and get through the wilderness and help you, get to where you are trying to get to. And, when I've been asked a few times on interviews, well, which is the most important principle, or what principle should, and, there is no important principle. Number 1 is not more important than number 5. But the order of the principles are I set out because they're they come in sequence, in the sense of this. If you're going to master them, if you're going to embody them, if you're going to kind of use them, you sort of got to start with the first one. And the first one is that everybody's different. Everybody's got a different situation, as I said before, not just different assets and liabilities, different income, different family situations, different age and demographics, different health status. But internally, we're all different. We have different, we're afraid of different things. We have different, we relate to money in a different way. So our objectives and what we're trying to get from the financial world and our financial situation is different. How much risk we're willing to take is different. Some people are willing to take a lot of risk. Some people are not. And then maybe the most important of the things that we differ on is how we view the future and the present. Because some people live entirely in the future. Some people live entirely in the future. But all of us are making decisions with respect to money that are decisions that are made now that will have consequences in the future. And that's sort of the fundamental nature of a financial decision. It's something you choose now with consequences later. And how you value things today in your current comfort situation, bank account, and how much value you put on what that bank account is going to look like a year from now, or 2 years from now, or 20 years from now differs. It differs from person to person. So, I have a good friend and colleague, Charlie Commander, who was a really great actuary who designed a lot of pension plans, and each plan was for a different company. And he said, if you've seen one pension plan, you've seen one pension plan. And that's the way I feel about financial plans. If you've seen one financial plan, you've seen one financial plan. So that's the first thing people need to, get, I think, before you can move towards financial wellness. You got to figure out what it means for you. Okay. Now, here's the second one, is very important, because what is your financial situation? Okay, many people will just focus on the assets. Maybe people will just say, okay, what should you do with your money? What should you do with your income? But that's only half the story. The other half is what you owe. So a lot of people will say, well, debt's really bad. Well, debt's neither good nor bad. But it's always important because it's the other side of your personal balance sheet. And not only that, but those debts and those assets include not just what you have today, but what you are going to get in the future, what income is coming your way, and what you're going to have to pay out. So your debt and your obligations are what's going to be paid in the future, as well as what you owe today. And this, I think, is absolutely critical for this audience, for you guys. Well, more so, I mean, I think it's important for everybody. I think it's important not just for the reverse mortgage experts in the audience, but also for the financial planners out there. But I think most of the financial planners probably understand that. But I think as a reverse mortgage expert, recognizing that not only is this principle absolutely critical to individuals as they make a financial plan, but what you have to offer is a kind of debt, and it's a kind of obligation that is, I think it's first of all very, very different than most of the debts that most consumers are familiar with. And like, we can argue about, is this debt good debt or bad debt? And, maybe credit card debt is mostly bad, but it has its uses. Well, I think HECMs and reverse mortgage obligations are mostly good debt. I mean, it's debt that doesn't have to be paid off until, how do you make a debt better? Well, you defer payment. Well, just by that measure alone, a reverse mortgage is a good thing. So, I'm not a reverse mortgage expert. I've learned more than a little bit from my work with Barry Sachs. But I know enough to know that it's a very important and a unique form of debt that you guys are all experts in. And I think that's very, very important.
As we work with our financial advisors and our loan officers work together, this principle number 2 we have to come to terms on that together, because the vast majority of financial advisors that I've worked with has regarded housing debt as something that is good to acquire a house, but bad to carry into retirement. The truth is that taking a payment into retirement is a challenge. Taking a loan that's not due until you're 150 into retirement is a very different situation. So we have to come to agreement on that principle too, because there is a lot of advisors that I've worked with that said, just get rid of your house payments so that you are free and clear by the time you get to 62 or 65, whenever you're going to retire. And that's something that we can spend a lot of time and discussion on, but that is a super important principle. And thanks for highlighting that as the second one, Peter.
Okay, well, and you make great points, Harlan, and I want to endorse what you just said. Now, principle number 3, this is the one where some people bristle. I know I had when I had an early version of my manuscript, I circulated to a number of my friends who were in the financial world. One of them was a very, very good independent mortgage broker, and he took some issue with the way this is written, because I also think that I say in the book, and I guess I modified it a little bit or expanded on a little bit in a recent essay I wrote, that you should really take due note of the compensation structure of the people that are advising you and helping you with your financial world, because you want to make sure that who's ever helping you is 100% on your side. And of course, the issue of using a broker who's going to get a commission, and if the deal is bigger, he gets a bigger commission, and the issue of is his or her interests the same as yours comes up again and again and again. And I guess this principle may be a little bit controversial in some circles, but I don't think it should be, because for me, everybody's going to need help. You can't do it all yourself, and you're going to need expertise and you're going to need advice. But I think you should get advice in the same way you get advice from a lawyer. You hire a lawyer to get you out of trouble, or find out if you're in trouble, or perform a transaction or evaluate a transaction. Well, in the same way, but every time you do, the lawyer's working for you, you trust him, and you're getting exactly what you hired them to do. Well, I think that should be the case in the world of money. And people get compensated in all kinds of ways. And I realize that now. So you're never going to be able to align the compensation, but you can hire an expert that you can trust. You do your due diligence and you find out that they know what they're talking about. And so to all of the, reverse mortgage people in the world, I think this. And I think that, meeting and getting your clients to understand the product and trust that you are an expert in it is important. And I think the financial planners as well need to take this to heart. And I'm not backing down. This is my position, and I'm sticking to it. I think when you get help, you need to trust that help. You need to make sure that trust is expert help. Okay, so I guess I need to go a little more quickly because I guess I have spent a fair amount of time on the early part of this, but I think this is fundamental and foundational. So I don't mind doing that. But principle 4 is, it's something that everybody has. It's an inconvenient truth. You cannot predict the future. You can imagine the future. You can imagine the possibilities. You can imagine the ways of the future may manifest. But whatever you do, you got to learn to live with that uncertainty and have a financial strategy that has flexibility enough so that you can change direction when things change, and hopefully is flexible enough to accommodate many of the different ways the future might occur. And so in the end, I think you need to be curious and open-minded about the future, curious about what's going to happen, and open-minded enough to recognize it might not turn out the way you think it will. Okay, now here is the 5th principle, and this, I guess you could sort of boil it down to advice that at least my father gave me, and maybe some of your own fathers gave you, which is hope for the best, but prepare for the worst. That's the first part of it. And then the second part of it, which is to strive to be anti-fragile, boils down to have a lot of irons in the fire, because you never know exactly what of your bets are going to pay off and which ones will be losers and which ones will be winners and how big those winners will be. But if you have lots and lots of irons in the fire, you have a good chance of turning out quite well. And you also will not, no one thing will completely destroy you. I mean, I guess, don't keep all your eggs in one basket is another way of putting it, but it's more active than that. It's keep a lot of irons in the fire. But the first part of it, which is, hope for the best, but prepare for the worst, I think is directly related to reverse mortgages. Reverse mortgages are, tailor-made to help a retiree hope for the best and prepare for the worst. You take out a HECM line of credit when you're 62 and you don't need it right away, or you need some of it. Maybe you need some of it to pay off your mortgage and keep the rest of that line of credit open and growing over time. That is a almost ideal way to prepare for the worst. You might need the money at some point for unforeseen contingency. You might need it for long-term care. It's there when you need it, and you don't have to, as I say, it's a unique form of debt because A, you don't have to take it on until you need it, and B, once you take it on, you don't have to pay it back until you move from the house or actually die. So principle 5, I think, is one where, when I give examples to all groups about how to apply Principle 5, I use reverse mortgages as a prime example.
You know, and interrupting again just for a second, I know you've got a lot of things to go through, but I want to remind everyone, when it comes to that, I can't count how many people I've said, do you think it's a good idea to, really be prepared for a big bump in the road, a death of a spouse, something on that order? And invariably, every financial advisor will tell me, of course. But yet the vast majority of financial advisors encourage their clients or permit their clients, without even discussing it, to have $300,000, $400,000, $500,000, $1 million tied up in a house that will do absolutely nothing for them when something comes along. And I had never heard the term before I read Peter's book, anti-fragile. There's a lot of people out there that have a pretty fragile situation, and that's fine as long as there's not a bump in the road. A bump in the road comes along and there isn't enough liquidity or enough tax-free money to be able to deal with that. And in practice, some of these things may seem incredibly simple. When I read the book, it's like, well, that makes sense. That's pretty simple. That's something my dad told me before I was even an adult. Well, how come we've went away from them then? And that's what I like so much about Peter's book, is it takes these things, it goes into a lot of the complicated stuff in every chapter that I've had to reread a couple of times. But some of these basics, we've got to go back to the basics. I come from Wisconsin, and Vince Lombardi told his players at the beginning of every season, this is a football. Sometimes we got to go back to this stuff. So thank you for doing that, Peter.
Well, okay. And again, you make great points, Harlan. I actually should go back and just say, well, what is anti-fragile? I mean, no, it's not a word that's in the dictionary. Well,
It looks like Peter froze up. Is that only me, Janet, or did he froze?
it is the opposite of fragile. I mean, what is fragile? Shake it or drop it or have.
It looks like we're having some technical difficulties with Mr. Neuwirth.
Okay, are you back now? Peter, we just lost your audio and we lost your slides. And you are still muted. So if you'll just, there we go.
I'm unmuted now, I think.
Yep, you're unmuted. We can hear you well. All you got to do is.
I'm going to get, what do I do? Share the screen?
Yep.
Just share the screen and bring that right back
All right, let me
up.
see if I can do that.
Just cycle. Let's see where you're supposed to be. Up one.
We are just on principle 6.
Okay.
There we go.
All right. Are we back?
We're back.
All right. Well, I don't understand the technology, so I leave the experts to deal with it. Anyway, so I was telling about anti-fragile, and so there are things that get stronger with under stress, like your muscles, for example. So, but I go more deeply into it in the book, and we really don't have time. But if you're interested in the concept of anti-fragile itself, there's a book called Anti-Fragile by Nassim Taleb, which gets into it in great detail, but I use some of those concepts. So, all right. So principle 6, it is kind of the end. I mean, you get through these 5 principles. What you realize is that you really need to be self-aware. It's not just assess your situation, but go through as you're going through the world of money with awareness of your limitations and your strengths. Make sure you know what you want, you know what you're going, where you're going, what you're capable and what you're not capable of. And when you're not capable, and ask help, get help, but find the help you need and use principle 3 to get the help you need. So with that, I'm going to shift to, okay, well, that's great. So there's all these principles, but what do you do now? Is there any practical aspects to this book, and I hope there is, because what I do in the last section of the book is I give you some sense of how to put it together. And again, I'm not going to tell you what to do. I'm not going to recommend anything to do. I'm going to tell you what I did, and I'm going to tell you why I did it, and I tell you the things I found useful. But the way I kind of look at it is, we are in a mountain wilderness, and we got to get through there. And yeah, it's good to know where you are with your terrain map and your compass and your binoculars, but you need some tools. And so what I've done here is to try to go through today the four basic tools that I think everybody should have in their backpack. And I'll go quickly because we don't have much time here. I see that we're almost to the Q&A time, but since I think people can stay for a while, I'll take a couple extra minutes. So what are the things that I keep in my backpack and I think I found very, very useful? Well, one is a house, and actually two houses, and real estate. You know, it's a place to live and a whole lot more. Permanent life insurance, another kind of thing, a kind of product that just like reverse mortgages had a bad initial reputation, because there were some, purveyors and people who were in that business who didn't have their clients' best interests. But it's, like reverse mortgages has evolved, and now it's managed by adults who are making sure that nobody gets abused by these products. Then there's what my friend Steve Vernon calls retirement income generators. And these are things like, and we'll see, basically annuities and other things you set up to just give you income throughout retirement. And then finally, financial planning goes, beyond the time when you actually need to financially plan after you're gone, and you want to leave a legacy. And planned gifts is a wonderful way of setting aside things, gifts for the future after you're gone, but still providing yourself current tax and income benefits. And so that's what these last 4 slides provide. And I'll just spend a couple of minutes on real estate, because that's the one that many of the people in the audience are most expert, that's where their expertise is. But real estate can be used for so many different things. And I have used my house and my 2 houses for the first 7, and I'm about ready to use number 8. I mean, as soon as my second house was burned in Sonoma County, where I live, and as soon as it's rebuilt, I'm going to get a reverse mortgage on it, because I do own the property free and clear. And once I get a reverse mortgage, then I can move forward and hopefully not too soon move on to number 9 and leave it to the next generation. So I'm going to just leave that slide, and we can go back to it when we get to question and answer, but that's probably the one that much of your audience wants to know about.
Well, it does. And obviously many of them have heard us talk about this before, but the fascinating thing is you started out this discussion with the 401k, and nobody put money into a 401k without the intention of taking it out in the future. We were told that when you invest in a 401k, you take it out in the future. When we put money into a house, we're not told the same thing. We're told to pay it off and never touch it again and not take any of the money out, which is really weird, because it's an investment just like anything else. You put money into life insurance, you take it out. You put money into a 401k, you take it out. We need to be educating our clients, because real estate is not only a wonderful place to have a roof over your head, but there is 8 other things that you can do with it. And so many people don't use everything that they've accomplished and just say, well, I've got a house and I've got a place to live, and forget that there's a lot of other things that can be done with it. And I love those, that long list. And if people need access to some of these slides, just let Reversed Events know and we'll get them out to you as far as a review later, because we're hitting the high points. But thank you for including that in as all of those different tools that are available.
Well, and I'll make one more point about that. Is again, great points, Carlin. Most people have both a 401k and a house. And that's fundamentally the research and the problem that Barry Sachs and I tried to take on. We tried to take on the decumulation problem from the perspective of the typical retiree who will have both a 401k portfolio and a house. And it's this coordinated strategy that many of you have heard of, that we believe is not a perfect solution, but a way to get at the decumulation problem. I'm just going to say quickly that I bought my first whole life insurance policy when I was 23 years old. I was single. I didn't have a wife or anybody to any beneficiary. I don't know who to put as a beneficiary. I think I put my sister or something. But it was a very smart, very, very honest and insurance guy from Northwestern Mutual, who was selling whole life insurance policies to actuarial students at the insurance company that I was at. And I bought one, and then I bought 3 or 4 more. And it's part of my retirement portfolio right now. And I won't go through all the ways you can use a whole life insurance policy. That's a subject of another presentation that's not here for today. So
by the way, one thing I do want to mention on that I was just at 3 different NAFA conferences in the last 3 weeks. The amazing situation is if somebody compares trying to pay off a house with instead putting some money into cash value life insurance, you will accomplish more with the ledger on the cash value life insurance, especially if you need it in your 30s or 40s and don't necessarily have the cash flow to put into it. So the relationship between investments and insurance and reverse mortgages are much more intertwined than a lot of the advisors actually realize. So
yeah, I mean, I'm sorry to interrupt.
No.
I was just going to but I was so excited about what you just said, because I'm still an actuary, and Barry and I still, do a lot of work together, and we do research together. And one of the things that we're doing research on right now is exactly what you just said, Harlan, is looking at, how a whole life insurance policy compares and how it can be integrated in the kind of not just the decumulation phase, but in the accumulation phase. So thank you for spurring me on to get going on that research.
We couldn't be more thankful that you're doing that. That's something that Barry mentioned. Let's not forget that the groundbreaking research of the coordinated strategy, the brains behind this was not only Barry Sachs, but also Peter, who you're listening to right now. That was some stuff that was way ahead of anybody else's time, that even Wade Pfau came after the fact. So we're thrilled that you and Barry started working on that way back.
Well, thank you. And I'm glad it's appreciated, because we had a lot of fun doing it. And so anyway, these last 2 slides, I'm not going to spend much time on it. I want to just open up for questions. But, here are the rigs that Steve Vernon, and Steve Vernon is really a fine actuary. And he's now I think he's a fellow at the Stanford Center for Longevity. And he has a consulting firm called Rest of Life Consulting. And he's been thinking about these problems for longer than I have. And, he's written a few good books on it as well. And, he talks about these rigs at some length, and, I'll let him do this talking about that. And then I just, this last thing is, again, we're all not going to live forever. And when we're gone, and fundamentally, what these gifts are essentially is you can buy an annuity from an insurance company, and they'll pay you while you're alive, and then they'll take the profits when you're dead. Well, you can also buy an annuity from a charity, from a university, from a not-for-profit, from an institution that you want to benefit. And they will also provide you the same, not quite as much income as an insurance company or a other financial institution will, but you know that the profits on that, because nobody who sells you annuity is doing it out of the goodness of their heart. They also want to make money on you. And the question is, where does that money go? And when you buy a charitable gift annuity, the profits go to an organization that you choose. So, and that's it. That's what I got for y'all. And
Okay, so there's a few questions that have come in, and a couple of questions that I will get over to Peter because he graciously said that he would stay on for a bit. But let me remind you of one other thing. When you take a look at, we already talked about the relationship between real estate, permanent life insurance, and even annuities. When you're dealing with, some annuities are for long-term care issues and so on, because obviously that's a big threat. If you truly have all four of these things, some people just think a 401k is enough, and it's not. Here's somebody that was at the beginning of the 401k program is saying, no, you need more than that. In some cases, a lot more than that, because some people just have a 401k and maybe a paid off house, and that's it. It's amazing to me the number of people that try to go through this wilderness that Peter is talking about here, and they try to do it with fewer tools. And they said, well, we don't really need a reverse mortgage. Well, that may be the case. My dad didn't need a reverse mortgage until he turned 86 and needed some money for home care. There's a lot of people that don't need a particular scenario, but it's awfully nice to have if you get into a jam or a snowstorm, or you trip down the mountainside, or whatever the situation is. And when you take a look at all of these things together, this is absolutely critical. And one of the things that I'd like you to comment on a little bit, Peter, is I've done 1,000 of these personally, and thousands more working with our loan officers at Fairway. So there's not much that I know. I don't know a lot about anything else except for reverse mortgages. But almost every one of those interviews involved a question of someone saying, well, yeah, but I wanted to give my house to my kids, or I wanted to give it to the charity. Well, if you have these other tools in place, like permanent life insurance or planned gifts, it doesn't matter if they get your house, because they're getting something else, and it's easier to give them a gift, a guaranteed life insurance benefit, for example, that transfers within an hour or with a month of death, than it is to try to give them a house that they most likely don't want to live in anyway. But can you comment a little bit further on that? Because a gift is part of it. There is a certain legacy that some of us want to leave.
Absolutely. In fact, so, like I said, the research I was referring to that Barry and I are kind of doing on insurance and accumulation, how that compares to saving for a house and 401k. That's next. The research that has now been completed, and we've actually presented the results at a couple of places. We presented to the University of Illinois, and I guess now Harlan and you guys are familiar with it, or at least familiar with the basic outlines of it, is about legacy and addressing exactly that question that you just raised, which is what happens to when I die? Will I be able to leave? What will I be leaving to it's great that you and Barry have developed this approach to maximize the income while you're alive without running out of assets. But have you done that at the cost of your heirs? Have you basically spent all the money that you possibly were going to leave? And the answer is no. The answer is absolutely no. So our most recent research looked at, if you take the coordinated approach and coordinated strategy of drawing down strategically from your 401k account when in good years, and your HECM credit line in down years. And again, I'm oversimplifying a little bit, but that's basically the coordinated strategy. If you do that, what will you be leaving? What do you expect to be leaving to your kids? And the answer is surprisingly more than you think. And not only that, what we've shown is that you'll be leaving not so much different amounts of total value. And when I say total value, I mean between your 401k, what's left in your 401k and what's left in your home equity. But the makeup of that legacy will be more 401k and less home equity. But that's okay, because think about the situation you're going to be leaving your kids in when you die. If all of the assets that you leave them are in the house, and now they got to figure out how to turn that into money, or maybe they want to live there, but if they don't, they're going to have to sell the house or find a way to do it. But let's say there was less home equity, but more of the 401k available. Well, that's a better situation for your heirs, because that's cash, that's things they can use. So I guess that's my answer. Does that address your question?
It definitely does. The number of people, I mean, I come from an agricultural area in central Wisconsin, and it was a big deal to pass on the farm along with the farmhouse to the kids. And that was just ingrained. We were primarily an agricultural society for a lot of years, and it was important to pass on the house to the kids. Now we see that 95% plus, in many cases, 99% of the time, the kids will sell the house, and they're after the money, not the house, not because they're greedy, but because there's 4 kids. I have 4 sons. Which one is going to get the house? I mean, they can't all live in it, and they don't get along that well. So the issue is that we must realize that if we want, all of my sons know they're going to get a check from a life insurance company, which allows me to spend my other money or use my other money for other things, because I've already got the legacy planned, and that's been more efficient than trying to save that money. And besides that, what happens if I die in a year like 2009? I'm not going to leave them as much behind. The life insurance death benefit is exactly the same in 2008 or 2009. The death benefit of the house is very different between 2008 and 2009.
Right.
So that's something that we want to make sure that we get across. One of the other questions is what kind of you touched on the advisor, and I've always said I'm more concerned about the character of the advisor than the compensation of the advisor. Obviously, we need to know how an advisor is being compensated, but just as far as the character, you had a chapter about charlatans. I've got charlatans, fools, and snake oil salesmen. How do we avoid these people? Because some snake oil salesmen, some charlatans look pretty good in the beginning, and you like them in the beginning, right, until later. So what are the kind of the key things, maybe the key questions? What do you look for to make sure that that advisor is on your side, regardless of where they're in the mortgage business or the insurance business, or in any type of financial advice business?
Well, that's a great question. And again, I got a wake up call when I got this, because I hadn't really been in touch with the mortgage brokerage world until and the whole real estate, what had happened in the real estate loaning world since the crisis. But getting that email from my friend who was a mortgage broker about how, it's not about compensation. It's about the person who's helping you. And that's really it. I mean, fortunately, when you get help and you need to get expertise, you're getting it from a real live person, a human being. I mean, we still don't have robots and AI, actually holding your hand while you do these things. And for me, it's due diligence. It's get yourself educated on exactly what you need and what you're asking and what the person is going to be doing for you. But then you got to do your due diligence on the advisor and the person. And I was struck because I guess a lot of the banks out there have this new initiative, Know Your Customer. And, really they want to find out a lot about you so that they can service you better. And it's all true. And it's something that I think you're the folks here, I mean, everybody in the audience, you want to get to know your customer. But I think it goes the other way as well. I think you need to get to know, as a consumer, you need to get to know your advisor. And I mean, really get to know them. I mean, ask them their story. Where did they come from? Why did they get into the business? So if the more you know somebody, then you can make a better judgment as to whether you trust them or whether they're actually selling snake oil.
Boy, that's an excellent point. So many people just rely on one meeting or whatever and don't really check into who they're taking advice from. Which brings us to another question, and that is when we take a look here at the future, and maybe this gets a little bit political, maybe not. I think whether people are Republicans or Democrats, it's pretty scary what's going on in Washington. Let's take a look through the binoculars. What do you see with taxes and what they're going to do with the, of course, taxes on 401ks, life insurance being tax-free, step up in basis, capital gains, just as an overall situation? Should we just automatically assume that things are just not going to be as good as they are this year? Or am I just being kind of negative about this?
Well, I tell you, I'll tell you a couple of stories. I mean, again, I was in the consulting world for 40 years, and through Democratic administrations, Republican administrations, and the thing and it was a very, very good career, and I feel well rewarded, and that's why I'm able to have 2 houses at this point. But what we used to say to each other was, it doesn't matter. As long as they change the rules, there's going to be business for the consultant. And so having seen Republicans and then Democrats and then Republicans and then Democrats, there's going to be change. And you just have to be ready to adapt to the change. We also had another principle in our, because, there's so many proposals that are out there, and I never really looked at things until there was a bill. And there was a bill. Not only was there a bill, but there were 2 bills. Usually there's 2 bills. There's usually a Senate bill and a House bill, and then there's a reconciliation. And so that the ultimate answer is going to be somewhere between, but you also don't know whether it's going to pass. So I try to just keep an open mind and wait to see what comes out. Do I think we have problems, fiscal and financial problems that need to be addressed? Yeah, you can't increase the money supply by 28% or whatever it went up by last year without having some kind of consequence and some kind of thing that has to be done. But what that's going to be done and what form it's going to take, I'm taking a wait and see attitude. And I don't know. I will tell you what I do or what I'm doing with my portfolio if you want, but that's I've been wrong and I've been right on a lot of things in my life in terms of making bets. So I don't know, that may not be a satisfying answer to the questioner, but that's sort of why.
No, it's hard to make plans when we don't know what the bill is. There's so many rumors going around that you certainly can't. I mean, some people talk like it's already happened, and it certainly hasn't. One of the things that we're seeing a lot of, and I'd be interested in your opinion on this because I haven't asked you about this, but we have a lot of people that are doing Roth conversions and using with free and clear paid off houses. I just had two this past week, between $1 million and $2 million in IRAs. And they feel that taxes are going to go up, not down, at least stay the same. And so they're pulling money out of the paying the 35% tax or whatever it is, 32%, and using their home equity,
Right.
which is tax-free, to pay for the taxes. And then they can roll over, if it's a 800,000, they're rolling over 800,000 into the traditional. Do you think that they're overreacting to move money too
No.
quickly? Or is Roth conversion a good idea at this point? Is it something
Well,
you do?
That's a great question also. And so, I mean, I realize I kind of ducked your question a little bit. So let me sort of say what I really believe, which is that something's got to give. Something's got to give, because we've been printing money for so long. And I mean, I see it at the Safeway supermarket. You know, prices are going up, and it's always struck me as kind of weird that you know, they measure inflation and then they say we exclude the volatile categories of food and fuel. And I think, well, that's what people buy. So why aren't you measuring? So, but like I said, I think something's got to give for all of the, you know, the things that we've had to do to get through these last year. Now, whether that's going to be higher taxes or higher interest rates or just, you know, much higher inflation, I don't know. But I think something's going to occur. So the Roth conversion that you're talking about, that's a very reasonable and thoughtful way of betting on higher tax rates. And higher tax rates is just one of several possibilities. And so that's what I say. So maybe doing a little of that, maybe doing like what I'm doing, which is buying comic books and some collectibles, because that they usually do well in inflationary times, and then maybe thinking about what you would do if it's interest rates where that go up because of having to correct for the and I don't want to call them excesses. I'm going to say that, you know, the Fed and what was done to get us through this last year of economic and other crises. You know, we maybe the other side of it, but we're still here, and that's what's important.
There's the last question I have, and if anybody else has any questions to type in, please do. The last question I have is, there's some people that simply have apathy. You know, I'm just kind of a victim. The government's in control. We're just kind of screwed, and they're going to print money. They're going to devalue our currency. They're going to take away our rights, you know, whatever. And yet your principle number 3 is full ownership of your situation. Yes, full ownership of your situation. Number 3.
Yep.
That it's up to you, regardless of who you hire for an advisor.
Right.
So how do we balance those two things? Because there are some things that we simply don't have control over. No matter what we do, we can still get, you know, taxes will still come into play, inflation, whatever. How do we balance that out?
That's a great question, and at one point I was thinking, to write a series of essays called, questions I wish I knew the answer to, and that's one of them, because we all, and I've got tremendous. I mean, I'm a neighborhood where I see a lot of people suffering and a lot of people getting discouraged and a lot of people saying there's really no solution, and so and people, but again, the kind of the inconvenient truth is that we do have to make decisions with respect to our money, and those decisions will have consequences, foreseen and unforeseen, in the future. I'm not so I really can't give people confidence or assurance where I just don't know that there's any to be given. But I do think that, taking a deep dive into your own situation and thinking hard about what you have and what you owe and what you might owe and what you might have in the future is a first step. And then recognize that it's going to be okay. It really, because everybody has the wherewithal to survive and even thrive in this environment. We have for thousands of years, and I think we're going to be doing it for thousands more years. So I guess that's the encouraging note I would leave with.
Well, I certainly agree with that. And there's way too many doomsdayers that say there's nothing I can do, and then they don't do what they know they should do. And that's frustrating to me, because that's where the irrational part comes in, which is a principle number 6, to have some fearless self-awareness and be open-minded and say, hey, I want to learn about this stuff. And it is something that I realize I don't know. When I realized all the things I didn't know, I still have a life insurance agent, a Northwestern Mutual agent, said to me years ago, if what you thought you knew about insurance was wrong, when would you want to know? And I said, well, I guess right now, because I told people to buy term and invest the difference. And so that's kind of the same thing I have in the back of my card, is what you thought about mortgages were wrong, when would you want to know? And so the number of people that are irrational and not open-minded and don't want to learn anything, and that's why we have these webinars and why we're so thankful. We just touched on a few points of the 100 and heavily footnoted 175 pages in this book. I encourage you to get with one of our loan officers and get a hold of this, because together, by one of our loan officers working on the debt management side and you working on the asset management side, oh my goodness, the number of lives we can help, the lives we can change, but it can't come with conventional thinking. What Peter Neuwirth has put together is not conventional thinking. It is something that was honed over 40 years of questioning things. And to not take advantage of his wisdom over the last 40 years is just plain foolish. I want to learn from him. I want to learn from anybody that knows more than I do, which is most people that I run into. And I very much appreciate it. And we want to work together. Fairway's goal is to work together with you to change the way retirement is done in this country. We can't do it by ourselves because we only manage the debt side. We need help from the asset management side. And by working together, we will change the way retirement's done in this country. And we thank you for taking the time. Peter, any final words that you'd like to say to kind of finish our call today?
I'll just put this last slide up and say, people around me sometimes get frustrated with the fact that I answer my emails, and anybody asks me for help, I'm ready to provide it, as long as you ask nicely and promise to listen to what I have to say. So, but I just want to say thank you for having me on here, giving me an opportunity to share what's I've been thinking about for the last few decades, and say reach out if you want to talk or contact me. I'm here, and thank you, Harlan, and thank you, Janet, and the whole crew at Fairway for having me.
We're lucky that you took the time and are dispensing this information. We look forward to some future ones, diving deeper. This was the introduction. And I don't know if you've ever read a financial book that has a foreword from a professional poker player, but that should give you the first clue right on the cover that this is not your average book. We need this information. We need to get it out to all of you, all of us. And just as soon as we found out about it, we got it out to our Fairway folks, and we want to make sure that we understand that. Thanks a ton for attending. Just get with the loan officer that invited you, or with Reverse Events at fairwaymc.com, and we'll be thrilled to help you out. And if you got any questions for Peter, you've got his contact information right there. We appreciate every one of you. And thanks again, Peter, and Julia, Paige, thank you. And we could not be more thankful for your wisdom. We're going to do the best to take advantage of it and change some lives.
Okay, thanks.
Everyone, have a great rest of the day. We appreciate you being on. Talk to you soon.